Hello and welcome to today's ASX Investment Opportunities in Review. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. The technology I'm using today is the Investor Signals member area. If you'd like to gain access to it, it's $1,320 for a year. You can start your free trial by visiting investorsignals.com or call the office on 1300 614 002. The purpose of today is we're going to look at the stocks in the ASX 100 model that are under buy conditions and narrow down the focus to a select group of stocks that become the opportunities that we'll be focusing on in the commentary on the blog and in upcoming recordings. And the idea here is that you should be making a note of these and start to add them to your watch list with a view of ensuring that your portfolio has exposure to some of these names. So the first step is we get the percentage gainers to the top for today. We organise the signals in buy order. So now what we're looking at is the best percentage performing stock today that's under buy conditions. If we continue to scroll down, you'll see the percentage rise is falling, and then eventually the list switches from buy conditions into stocks that are under sell conditions. So for the moment, what we're going to do is go through and identify the high quality stocks under buy conditions. So Ansell's had a big rally off support there at around $20, pushing up to $26. Stocks with US earnings that are converted back to Aussie dollars are continuing to hold up better than most in the market. Technically, when you think about sort of the sell-off that we've had, quite often you're going to run into a first level of resistance at sort of 50% rebound of that area. Ansell at around $28 we think sort of recaptured that initial part of that bounce. The energy names are still avoiding at the moment, and something to consider is the triple O ETF, which is the oil ETF, and I'll have a look at that at the end of today's recording. But rather than buying the individual names and taking on balance sheet risk, if you're going to go long energy as an alternative to these stocks, you can think about the triple O ETF. So Cochlear are comfortable here. They've moved quickly to shore up their balance sheet and raising equity at $140 a share. The stock looks reasonable value, and they're obviously a leader in their market segment, and we think that they can, while sort of elective procedures at the moment are in a difficult environment, we're probably likely to get through that fairly quickly, and we see sort of some normal sense of demand and business conditions returning for Cochlear quite quickly. So at around this $170, we're attracted to a Cochlear as an opportunity in this market. Altium under algorithm buy conditions, we're not doing too much there at the moment. We think there are better opportunities within the tech play. CSL continues to perform well, so if you think about sort of that low that it made a week ago, we've now rallied from 250 back to 300 there in CSL. CSL remains one of the better performing stocks in our algo model portfolios. Insurance Australia Group recovered nicely from around 5 back up to 610. Don't see this doing too much more than sort of that 6 to 650 range. So better opportunities in the market at the moment. BlueScope Steel down here at around $9. I think that's reasonable, and you can maybe think about that with a stop loss below the recent low there. Aristocrat Leisure, so again, think about this as a technology play, sort of the group within that tech space are sort of and we'll look at these closer, but you've got REA Group, Car, Seek, Xero, and Aristocrat, sort of all within that tech opportunity within the ASX 100. So Aristocrat is probably not our favourite sort of within that group. So REA, Car, and Xero, and we'll have a look at those as we move through these charts. Again, Oil Search has had problems with the Papua New Guinea government. Those negotiations broke down, which has partly sort of impacted the aggressive sell-off here in oil search. When I'm looking around these energy names, probably Origin, or Woodside Petroleum, but again, you just come back to the benefit of just buying the oil ETF and having exposure there and not taking on any of the balance sheet risk. Coca-Cola, so some of these, so Coca-Cola, Woolworths, Coles, you can start to think about these as income trades using buy right strategies where you're buying the stock, selling call options. You're probably stripping out a call option premium either out to December on the other side of the next round of dividends, which will be September, or alternatively coming in closer and selling calls around June and trying to generate effectively 2 rounds of income, one from the call option into June and then the second round from the dividends in September, to drive higher cash flow. At the moment, we see the downside risk in Coca-Cola, Coles and Woolworths fairly low at the moment. Ramsay Healthcare, we're starting to see a pivot there where, again, the elective surgeries is a difficult environment, and Ramsay's reallocating hospital beds, working with the Australian government for coronavirus patients to be utilising those facilities. So with the Aussie banking sector, is really interesting to try to get your head around what the ultimate losses look like for the Australian banks as we start to see the economy shut down. And the $1 million question is it for 2 weeks or 2 months? And probably somewhere in the middle of that, is the answer. But the long-term impact that it has on the credit defaults within the banking sector, whether it be across credit cards, home loans, it's hard to actually quantify that at this point in time. But at the moment, it looks like CBA and Macquarie are likely to hold up the best, whereas say NAB and ANZ and Westpac were a little more cautious on. Alumina, not doing any there at the moment. So Sonic Healthcare, I think this is one you can add to your list. I think Sonic has found support at $20. So Sonic withdrew earnings guidance, but it looks like earnings will be down about 20% in 2020, puts the stock on about a 3.2% dividend yield, so it expected to find support at around these levels that it's trading. So again, you could consider this as a buy right opportunity. We don't see it recovering too much above sort of $25, so owning it here and selling a covered call is a way of driving higher cash flow out of the market. Not being there in Challenger at the moment. GPT is still a little bit cautious on these property stocks. Again, it's hard to get visibility on the impact that it has on their earnings. GPT is more commercial office space, but still likely to be significantly impacted by this. Wesfarmers, preference is Coles and Woolworths for their defensive characteristics. Again, hard to sort of understand what the impact ultimately ends up being on, say, the Bunnings business as an example. But Wesfarmers is under buy conditions, and we've flagged support there around $30. REA Group, so again, just revisiting these tech names, REA, Car, Seek, Xero and Aristocrat. REA Group's clearly going to have a significant hit to earnings from a slowdown in residential listings, but it is an area of the market that we'd expect to rebound in the second half of this year. And again, they're sort of the dominant player within that sector. Evolution Mining, so these gold names, I think this is an area that you can start thinking about if you're not if you don't have current allocation of gold stocks. Newcrest, North Star, Evolution. Looks like gold had a great week last week, and I think it's setting up again to probably continue with that rally. So having a look at those 4 gold names, or the GDX gold ETF, is something you want to be thinking about this week. Westpac again, CBA and Macquarie look better choices out of the banking sector, or looking at the MVB, which is the broad banking ETF, or if you want to get out of Australia and look at the banks at a global level, BNKS, which gives you exposure to all the global banks as an ETF. Woolworths, so This here makes sense to us at the moment as a buy right, so buying it here and selling calls again either into June or going out further on the other side of the September dividend. Lend-Lease, cautious on these property names still. Coles, buy right. Preference Woolworths over Coles at the moment. Horizon starting to get back to a level where it runs into resistance, at around this sort of 475. It's full value, so expect that to run into selling pressure shortly. Cleanaway, so this will take a little while for the support to develop here, but at around this 160, 170, Cleanaway looks like a good opportunity in this market. So think about adding that to your portfolio. The stock trades on only around a 2.5% dividend yield, but a lot of the income stream is contracted work, and sort of the shift in policy around generating a circular economy. Cleanaway sort of sits in a good position there, and we've seen them make some small bolt-on acquisitions in that recycling space. We see that as an area for potential future growth for Cleanaway. And in a low interest rate environment, 2.5% yield with some earnings growth remains an attractive opportunity. So as the volatility settles down, we'd expect to see investors come back into Cleanaway there. Computershare, not doing too much there at the moment. Telstra, think about this, down at around $3. Telstra looks like it's providing an okay level of support there on about a 4.5% yield. So again, seek sort of within these tech stocks. Probably seeks further down the list. So REA and CAR and Xero are our preferred allocations at the moment. Macquarie Group, so around this $80, does it find support again? The visibility on these, on the impact to the bank's earnings is really hard to get sort of clarity on at the moment, and for that reason we're still a bit cautious on the banks. NIB holding, so as this rallies up to around this $5 to $5.50, we think that runs into resistance there as well. Not doing it there in Bendigo. ResMed finds support around $23 here, but currently not our preferred allocation. ASX, we've continued to sort of see this as a safe harbour within the volatility of the market, the increased transaction flow, which we'll start to see some data on that in the next fortnight. And we'd expect that to probably cause a pop in the share price, but it may be a rally that you want to sell into, because on the other side of this, we expect as the volatility settles down, transaction volume will fall away again. But this March quarter will be an extremely strong quarter for transaction-based income for the ASX. So if we were to see a spike up between that $75 to $80 level, that's an opportunity to take profit on ASX. Magellan, not doing too much there at the moment. North Star, so that adds to these gold stocks, so just to revisit that. Newcrest, North Star and Evolution. So gold had a great week last week. It's done well over the last month, and we expect to see further buying interest come into the gold sector this week. JB Hi-Fi, not doing there at present. So Xero, part of that tech basket that I've mentioned. Medibank Private, not doing there at present. And Star Entertainment, so you've seen Star and Crown come out of suspension, but again, little visibility as to the timing of when business returns to normal there. Amcor's back at full value at around this $12.50 to $13. Looks like an area that it consolidates and moves sideways. We don't see that rally continuing just yet. Likewise with Brambles, resistance there at around this sort of $10.50 to $11 level, so moves sideways or starts to run into a bit of profit taking. APA Group back up at between 10 to 10.50 is resistance there for APA at the moment. QBE, not too much there. Fortescue, so iron ore's held up very well, and that's for a number of reasons. Expectations that China create construction sort of or stimulus through added infrastructure projects as we come out of this coronavirus sort of slowdown. We've had supply come off the market with I think there's a dam fail issue in South America with Vale, one of their large iron ore operations, which has impacted supply. So iron ore's held up better than we've seen in most downturns in the market, so with iron ore remaining in the mid-80s. Andrew Forrest was a buyer of Fortescue on this sell-off down here at around $8. And for the most part, Fortescue, BHP and Rio have held up okay. We need to keep an eye on that iron ore price, and a break below $80 might be an area to be, and reason to be a little more cautious on BHP, Rio and Fortescue, but for the moment they're under buy conditions and holding up well. Oz Minerals, so take a look at this back at around 650, and I'll keep you updated on the blog. There may be a short-term trading opportunity there if we see a little bit of softness there early or mid this week. We might be able to buy that as a short-term trade in the market. James Hardie, within this building space here, I think just keep an eye on Boral. It's sub $2 at the moment. If you think back to, and it might be a very early consideration, but if you think back to post GFC, the Australian government put in policies to stimulate new housing construction, and in the coming months, when the government's looking to ensure people are back into the workplace, they may announce stimulus policies which Boral might be a direct beneficiary of. So keep an eye on Boral as it trades below $2 a share, and we'll revisit that on the blog over the coming weeks as well. AMP not doing too much there. Afterpay had a good recovery from that $7.50 level up to $22. It's settled back down at the moment. Goodman Group, so within the property play, this is really the only stock that stands out to us as a defensive sort of proposition. They came into this with very low gearing, only around 10% gearing, growing earnings at about 8% per annum. The correction that we've had now puts the stock back on around about a 3.5% dividend yield. They're servicing a different segment than most. They're focusing on logistics centres, which distribution centres, which are part of the growth in online shopping, mainly in Australia and throughout Asia. So Goodman Group, we may look back in coming months and recognise what a good buying opportunity this was, down around $11. So if we're looking for something within the property space, that's the name that we gravitate towards. TPG Telecom, this is $6.75. I think it's probably looking at it like a reasonable defensive entry point into that. Orica, so should find support down there at around $15. Car sales, so within this tech basket, so car sales we don't mind. Obviously recognise that there's short-term difficulties the business is facing, but again, they have a good brand, global business reach, and we think that that'll be an early sort of recovery stock that could easily trade back up to that $15-16 range in the back half of this year. I'm not think they're in Dexus or Mirvac, Flight Centre. Origin, I think this is one you just need to keep on your watch list, maybe run tight stop losses below recent lows, but Origin has the potential there to trade back into that sort of $5 to $6 range, and we see the downside risks is fairly low there for Origin at the moment. Rio, so support there at around 71, rallied up to 90, ran into a bit of resistance there, and we're just keeping an eye on how iron ore prices trade into the back half of this week, and again I'll update you on the blog with that. Transurban, so this within the infrastructure area, we see this as a relatively low risk proposition, so we will see a cut in the dividend yield, so it'll probably come back down to around 48 cents a share from slightly, I think it was trading around 51 or 52 cents a dividend, so we'll see a slight cut in those forward payouts. but it is an infrastructure stock where, as people return back to work, you're likely to see a quick sort of re-acceleration back up to levels that traffic flow levels that we saw prior to this. So I think so opposed to say air travel, you'd expect maybe transurban returns back to business as usual a little bit quicker. So it's if I was looking for something, and again the gearing levels are low, and they have certainly a competitive dominant position in the market. BHP, BHP offers a slightly more discounted entry opportunity into their broader portfolio, and that's been weighed down by their exposure into energy. It's just hard to get that visibility on, what does that demand look like out of China, and is there a period that it slows down before it re-accelerates there, and for that reason we're just keeping a close eye on the spot price in iron ore and sort of using that as a catalyst to drive our view on BHP and Rio. Qantas not doing there at the moment. Caltex has taken a substantial hit to short-term earnings, both on a refinery basis and on a retail outlet basis. The offer at $35 a share looks like it's going to be revised, or at least withdrawn and revised. But I do think Caltex is a stock that you want to keep on your watch list. I think if you look 6 months out, it is a business that at these prices looks cheap relative to, again, a company that should rebound fairly quickly, and we'd expect that to maybe trade back up to that sort of $30 level. So keep that one on your watch list. Not doing there in Soul Pattinson at the moment, or ALS. Sydney Airports, Newcrest Mining, so this is one that you want to make a note of, and we're looking for Newcrest North Star Evolution to start trading higher this week. We like Newcrest out of that basket. Downer EDI not doing there at the moment. Cube not doing there, or Santos. And then there we are. So I'll have a look at that oil ETF just for you to make a note. So it's a beta share crude oil ETF. It's O. So again, this is if you're going to buy any of these energy stocks, you're taking on balance sheet risk, whereas if oil price, it's unlikely that the energy stocks do better unless oil begins rallying. So you might just keep an eye on this graph here, look at the short-term indicators, wait for those to turn positive, run a stop loss below the low before your entry, and think about that. The tech stocks we've revisited, so I'll just go through the list of names just to ensure that you're able to make a note of these. So Newcrest, so gold starts to rally, so Newcrest North Star our preference. Within the healthcare space, Cochlear, CSL and Sonic. Defensive income plays, think about Coca-Cola, Woolworths and Coles, and you may want to run buy right strategies there to drive the income. Telstra at $3 looks good value. Cleanaway, we think that's a good high conviction stock for you to hold in your portfolio over the next couple of years. APA Group, obviously that's one that we've liked. It's getting back to levels that we think starts to run into resistance. The same with Amcor. And then within that tech space, you really want to make a note of this basket and keep an eye on these being REA, Car, Seek, Zero and Aristocrat. And I'll update you on the blog when we're looking at the entry opportunities in those names. And then again the oil ETF being O. Thank you for listening in, and I look forward to speaking again next week.